The FedLife podcast is presented by Serving Those Who Serve, a fiduciary, fee-based financial planning firm serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of Raymond James. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc. And now, here are your hosts. Dan Sipe serves as a branch manager for Raymond James Financial Services and Serving Those Who Serve. Ed Zerndorfer is our guest and federal benefits expert in the space.
Hello and welcome to this episode of FedLife Podcast. I'm your host, Dan Sipe. If you don't know me, additionally, I'm the branch manager at Serving Those Who Serve and Lee Sipe Associates. Beginning as I always do by saying thank you. Number one, thank you for taking the time to watch or listen. But above all, thank you for your service to the government, to the country, to me, to everyone. You don't hear it enough, but you will always hear it here. Once again, we've got the guru with us, Ed Zerndorfer, as part of our ongoing mission to reach, teach, and serve you, the career civilian feds. This is part two of a two-part series of something that's a big deal for 2026, and that is the new Roth TSP in-plan conversions. If you haven't listened to episode one, I encourage you to go back to do it and read the accompanying article. They're both up on the website. So today for part two, we're tackling the big question: should you do a Roth TSP in-plan conversions? And Ed has laid out some important questions to consider and two critical 5-year rules you need to understand. So, Ed, your article emphasizes that because of the federal state income tax consequences, anyone considering a Roth TSP in-plan conversion should first consult with a tax advisor. You touched on it in part one. Please tell us again in part two why that's so important.
Yes, the the Roth TSP in-plan conversion is converting parts of your traditional TSP account to Roth TSP has federal and state income tax consequences. In some cases, it can be it can be a shock what someone would owe in taxes. So before anyone, whether you're an employee or retiree, decides to do this conversion, please sit down with a qualified tax advisor to go over the immediate tax consequences of performing this conversion. Now, when I say a tax advisor, I want to repeat again what I said earlier today in terms of what you cannot do. You cannot call the TSP and ask them for tax conscious. The TSP is not allowed to answer tax consequences. They will tell you need to go to your tax advisor, a qualified tax advisor. Also, if you have a financial advisor, anyone, whether it's a stockbroker, whether it's you do your banking, you have a banker
Sure.
who gets you advisors, whether you have an insurance agent, insurance broker, something like that who is an advisor, they are also not allowed to give out tax advice.
Absolutely.
You need to go to a qualified tax advisor. Now, when I say a tax advisor, I'll be a little biased, a CPA or an enrolled agent, someone who has that title, who is allowed to give you tax advice. Very important.
Couldn't agree with you more. Now, Ed, you put together a really helpful framework in your article, including a side-by-side comparison. So, folks, if you haven't done so, hit FedZone and pull that up because it'll be very helpful for you. But side-by-side comparison of when a Roth in-plan conversion might be right or might not be right. So let's start with the positive side. What are the signs a conversion might be right for someone?
All right, I'm going to pose 3 questions here.
Okay.
So someone who's thinking about doing this this Roth TSP in-plan conversion, here are 3 questions. Will the traditional TSP participant be able to pay taxes from personal funds, particularly, ideally, liquid assets? We're looking at cash, passbook savings, or money market account on any tax on the taxable portion of the conversion. keep in mind, when you convert traditional TSP to Roth TSP, it has immediate tax consequences. It's going to be added to your income in the year of conversion. Second question. This is a biggie. Will the traditional TSP overall tax bracket be higher in the future? Now, it comes down to one simple fact, Ian. And this is we get this question all the time. I know I'm allowed to contribute to the traditional TSP. I'm allowed to contribute to the Roth TSP. And the question usually ends up saying, for the person, which account is better? The question should not be which account is better. Which account is more appropriate given your overall financial situation, particularly taxes? The general rule is this, that if a TSP participant expects to be in a higher overall marginal, what do I mean by overall marginal tax bracket? Federal and state. At the time they withdraw from their TSP account compared to their overall marginal tax bracket, federal and state, at the time when they contribute to the TSP, then the Roth TSP is a more appropriate account, because this way you pay the tax now on the contributions to the Roth TSP at a lower rate than you would had you kept it in traditional TSP and take the money out down the road.
Gotcha.
On the other hand, if one expects to be, the TSP participant expects to be in a lower overall marginal tax bracket at the time they take money out of their TSP account compared to their overall marginal tax bracket when they contribute, then the traditional TSP account is more appropriate. Now, Dan, we know that tax rates are low now, right?
Absolutely.
The Tax Cuts and Jobs Act of 2017 lower individual tax rates to the lowest they were ever. And that took effect January 1st, 2018. They were due to expire on December 31st, 2025. They didn't, because Congress and the president signed OBBBA, the One Big Beautiful Bill Act, that kept those individual tax rates to the lowest they had ever been in 100 years.
Gotcha.
Now, will they stay low forever, Dan? What do you think?
I'm going to guess no.
I don't think so. It's eventually, they have to go back up. They have to.
Sure.
So if one thinks that they're going to be in a lower overall tax bracket by the time they take the money out, I really doubt that. I really doubt it. So that being said, it seems like the Roth TSP account would make sense. Pay the taxes now, convert now while rates are low, and this way you don't have to worry about paying higher taxes later on. That's the consideration. And third question is, will the traditional TSP participant keep the amount that they're converting invested for at least 5 years? What is this 5-year rule? We're going to talk more about this a little bit later. I'm saying this because if there's anybody out there, a retiree in particular, who is looking forward to converting their traditional TSP account to the Roth TSP for the purpose of paying the tax now, but maybe in 2 years taking the money out tax-free, you can't. I'll explain later on. You got to wait 5 years. 5 big years. And we're going to explain it. It's a little more complicated than that. There's a 5-year rule. Okay?
Gotcha.
So those are three reasons why somebody should think about, when they're thinking about converting TSP. If they can answer those questions, yeah, that would be a yes. Then they're candidates for doing these Roth TSP and plan conversions.
Gotcha. Okay, now let's flip it. What are the warning signs that a conversion might not be the right move?
There are actually 4 questions. So here's what a traditional TSP account, a traditional TSP participant has to ask. If they say yes to these questions, maybe they shouldn't convert. Here's the first question. As I said a few moments ago, when you convert your traditional TSP, a portion of your traditional TSP to the Roth TSP, it is a taxable event.
Mm-hmm.
And the taxes have to be paid in full, federal and state, in the year that you convert it. Will paying taxes on the taxable portion paying these taxes be a hardship? Do they have the money to pay the taxes due on the conversion? We did an example earlier from the first podcast. We had somebody named Jessica. She converted $50,000 of her traditional TSP to $50,000 of her traditional TSP to the Roth TSP, 22% tax bracket, 22% tax bracket, federal, I think 7% state. So how much tax did she owe? 22% of $50,000 is what, $11,000. Then a 7% state tax, that's another $3,500. This is a lot of money. The taxes have to be paid sooner than later. You can't wait till the following year, April 15th, when your taxes are paid. You have to pay it. It's called estimated tax payments, and you have to pay it. You have to pay it all within that quarter. IRS is not going to wait a whole year to get their money. They want it sooner than later. And if you don't have the money, I guess you can't pay the taxes. You're going to be subject to an underwithholding penalty. Okay. Next question. And this is what we've talked about here a moment ago. Will a traditional TSP participant's overall tax bracket be lower or the same in the future? Because if they expect to be in the same tax bracket in the future, it's possible, okay? It doesn't make sense for the conversion. I say that, we have a monthly TSP webinar. We run through the comparisons, traditional TSP and Roth TSP, and we do actual conversion where somebody higher tax bracket, lower tax bracket, and they take the money out. Same tax bracket when you put the money in as when they take them out. We show the comparison. So if they expect to be in the same overall tax bracket, it doesn't make sense to conversion. You'll end up with the same amount of money after taxes. If they're going to be in a lower tax bracket, then it really doesn't make sense to the conversion. Because you're going to be paying higher taxes now, paying higher tax on when you do the conversion compared to had you not do the conversion. I really, really doubt the person's going to be in a lower tax bracket. If anything, it's going to be in a higher tax bracket. That's my gut feeling.
Sure.
Okay. Third question. Will the traditional TSP participant need to withdraw the conversion money within 5 years? If they do, if they're going to have to take the money on 5 years, don't do it. Because you're going to end up paying taxes again and maybe a penalty. We're going to talk about this 5-year rule a little bit later. Okay. And here is another question. Suppose you don't have enough liquid assets to pay the taxes. Are there any alternatives to increasing your Roth TSP account balance? Well, here's one. Why don't you just contribute directly to the Roth TSP? Roth TSP, just make direct contributions to Roth TSP via payroll reduction. This year in 2026, if you wanted to put all your money into the Roth TSP, the contribution limits went up. Everybody could do at least $24,500 manager age. Catch-up contributions increased also by $8,000. There's a super catch-up of $1,250. So put all your money into the Roth TSP. Roth TSP, just won't have to worry about paying your taxes one time, just on the contributions. And there it grows tax B. And we also talked about this earlier, but we did a little bit that as an alternative to converting to the Roth TSP, you could take your traditional TSP, do a direct rollover to a Roth IRA, and convert the traditional IRA to a Roth IRA. the Roth IRA and the Roth TSP have a lot of similarities, but both are not subject to RMD. But I want to give everyone a word of caution. I didn't mention this in the first podcast. Be careful when you go via the Roth IRA, traditional IRA to Roth IRA conversion. I'm saying that because there is no Roth IRA out there that's free. You have custodial fees.
Yeah.
So when you roll over your traditional TSP to a traditional IRA, you have to take that step. That IRA is going to impose a custodial fee. It's a custodial fee. And initially, then you pay the taxes due on the conversion. And then you decide, after you do the conversion, you want to go to a different IRA, a different family. You're going to pay another custodial fee.
Gotcha.
One of the true virtues of the TSP is its low costs. It's low cost. You don't pay an annual custodial fee. The expenses are low. We're talking about the core funds, the CSI, F and G funds, the life cycle funds have low costs. You're getting the most of your money. So you should try to keep it in-house. So
Gotcha.
These are some of the questions you have to ask yourself before you embark on this Roth TSP and plan conversion.
Great points. Now, as promised, we're going to dig into these two different 5-year rules that apply to the Roth TSP and plan conversions. These can get confusing. So, Ed, take us through the first 5-year rule.
Okay. So, actually, as I said, there are actually two separate 5-year rules. Actually, two separate 5-year rules that apply to withdrawals from the participant's Roth TSP balance. Okay. The first 5-year rule applies only to the accrued earnings in the participant's Roth TSP account balance. This rule determines whether the participant pays federal and state tax upon the withdrawal of those Roth TSP accrued earnings. Now, what are we talking about here? We're talking about the accrued earnings that once you have converted a portion of your traditional TSP to the Roth TSP, at that point, you accrue earnings from that point in now this Roth TSP account. How long do you have to wait to take out those earnings? Okay. All right. And the second, and we're going to go a little more, let's pursue this in a little more detail. This 5-year rule applies only to the accrued earnings in a participant's Roth TSP account balance and determines whether the participant can withdraw those earnings federal and state income tax free. We talk about accrued earnings, we're talking about interest income, dividend income, maybe capital gains income within the account. Okay. Therefore, accrued earnings on Roth TSP conversions that are included as part of Roth TSP conversions, Roth earnings are not taxed if the distribution is qualified. Okay. Now, Roth TSPs become qualified and can be withdrawn tax-free when they meet both of these requirements. Okay. The 5 years have passed since January 1st of the calendar year in which the participant made his or her first Roth TSP contribution, or if the participant has never contributed to Roth TSP, when the participant performed that first Roth TSP in-plan conversion. Okay. Just everyone should note that the Roth TSP account has been around since 2012. And also, now the second requirement is the participant has to be at least 59 and a half. Let's do an example to help better understand, because it's a lot easier to understand when we do an example.
Go for it.
All right. So here we have Marie. Marie made her first Roth TSP contribution on July 27th, 2019. For the purpose of the 5-year Roth TSP participation rule, Marie's 5-year period started when? On January the 1st, 2019. No matter when you make that Roth TSP contribution, that first one, anytime during the year, the 5-year meter starts as of January 1st of that year. If somebody made their first Roth TSP contribution on December 24th, 2025. When does the 5-year meter start? January 1st, 2025.
Gotcha.
Okay. So now, Marie is currently 60 years old. She's 60 years old now and intends to perform her first Roth TSP implant conversion on February the 3rd, 2026. Since Marie is over 60 and will be at least 5 years since January 1st of the year that Marie made her first Roth TSP contribution. When did Marie's 5-year waiting period, called a specific, when did it start? January 1st, 2019. When did it end? January 1st, 2019. Here it is, February 3rd, 2026. Okay. If, let's say, she decides, I want to take out, let's say before I do my conversion of part of my traditional TSP to the Roth TSP, I just want to make a Roth TSP distribution. Take money out. This is on February 3rd, 2026. If Marie takes out, let's say, $10,000 from her current Roth TSP account, would she have to pay any tax or penalty? Answer is no. Why? Is she over 59 and a half? She's 60. Yes. Dan, has it been at least 5 years since January 1st of the year she made her first Roth TSP contribution? Yes. This is her 5 years. Her 5-year period ended as of January 1st, 2024. Here it's February 3rd, 2020. She won't have to pay any tax. Okay? So that's, now, let's do another example.
Sure.
Okay? Stephen is a federal employee. He's also age 60. He has never contributed to the Roth TSP. He has a sizable amount, almost $1.2 million in his traditional TSP account. And he makes his first Roth TSP in-plan conversion on January 28th. First day in time. He admits, I'm going to jump on the bandwagon right away. January 28th. He creates his Roth. He does a conversion. Let's say $50,000. Okay. And he pays the taxes. He has now created his Roth TSP account. How long will Stephen have to wait before he can take the money out of his converted Roth TSP account and not have to pay any tax? 5 years. You'll have to wait till January 28th, 2031. Because he created his Roth TSP account when he did that conversion. Suppose Stephen has to get to that money. He has to make a withdrawal from that converted Roth TSP account before January 28, 2021. What's going to be the consequences?
He's going to have a problem.
What's that?
He's going to have a problem.
Well, the only problem he's going to have is he's going to have to pay tax.
Right.
Federal and state income tax on the amount he took out. Will he have to pay an early withdrawal penalty? No, because he's over 59 and a half.
Yep.
So I would advise Stephen, if I advise him, just take it out of your traditional TSP.
Sure.
Why leave that Roth TSP account alone? Okay, that's what I advise.
Gotcha.
So that is the 5-year rule. That's the 5-year rule regarding accrued earnings. Now let's.
So we've got a second.
There's a second rule.
Yep.
It's called the 5-year rule for converted amounts. For the converted amounts. The second 5-year rule applies only to money converted from a traditional participant's balance to the participant's Roth TSP balance. Each time a Roth TSP in-plan conversion is performed, a traditional TSP participant starts a 5-year clock that begins on January 1st of the year of each conversion. If a Roth TSP participant makes a withdrawal that includes converted money within 5 years of conversion, then the Roth TSP participant must pay a 10% early withdrawal penalty to the IRS unless an exception exception applies, such as being over age 59 and a half, or maybe they're disabled. This 5-year rule only applies to the money that the traditional TSP participant converted, not the earnings on that money. This IRS rule is designed to prevent traditional TSP participants under the age of 59 and a half from avoiding the early withdrawal penalty by converting their traditional account to a Roth TSP account. It is separate from the 5-year rule that determines whether the participant's Roth TSP earnings are qualified and can therefore be withdrawn tax-free. Let's do an example. I have someone named Margaret. She has both a traditional TSP account and a Roth TSP account. She plans to retire at her full retirement age of 57. Over the next 2 years, Margaret intends, this is between age 55 and 60, she wants to contribute $20,000 to her Roth TSP. She's going to do direct contributions. And then she's also, on February 10, 2026, she's going to convert $50,000 of her traditional TSP to the Roth TSP. But she has to wait. But she's going to have to wait until January 1st, 2031 to make penalty-free withdrawals from her Roth TSP and conversion. She's going to have to wait. Even though she met the 5-year rule, she's over 59 and a half, okay? And she met the 5-year rule for her, what's called contributory Roth TSP account. We have to differentiate between what's called a contributory Roth TSP account. That's where you directly contribute to the Roth TSP versus the converted Roth TSP account, okay? And then because her 5-year rule start for the converted Roth TSP account starts as of January 1st, 2026. She did the conversion on February the 3rd, so the 5-year meter starts as of January 1st. So that's how it works. So it is complicated. It's not easy to understand. I suggest that listeners, anybody listening, should go to those columns in the Fed Zone we learned. Also, I'm going to make a pitch. I'm going to make a pitch now once again for our monthly webinars on the TSP. Serving Those Who Serve has a monthly webinar on the TSP. It's been updated, just been submitted, and will include all the details of what we talked about during this podcast, including converted. I have a whole section now on this business of converting traditional TSP. And then if you attend the webinar, you can ask questions directly.
Absolutely.
So please, as I say, it's held every month. To sign up, go to the website there. And I think you will definitely get a lot out of it.
Absolutely.
One more thing, Dan.
Oh, go ahead. Yeah.
One final thought here. I hate to mention this. I feel like what I'm going to say now, I'm like the Grinch, the post-holiday Grinch. And this is what I was thinking about. Dan, I don't know if you and any of the advisors have gotten this question. Is it possible that Congress could change their mind and in the future they could tax Roth IRA, Roth TSP distribution? Is it possible they could change their mind?
It's possible.
I'm saying this because this year we talked about, about the fact that Congress was was thinking about not taxing Social Security. It didn't happen. Social Security is still taxable. Same rules. Was Social Security always taxable? Social Security started in 1940. And then from 1940 through 1982, Social Security was not taxable. But then the law changed. Social Security Act of 1983 changed that. For the past 42 years, Social Security is taxable. It's going to continue to be taxable. What I'm saying is, it is possible that Congress could say, listen, we gave you a freebie for the time being, but the deficit is up there. We got to change the rules here. Now, I would say this. They wouldn't just do it. They would probably grandfather the sense that as a certain point, any earnings accrued in your Roth accounts would be taxable. Anything up to that point will come out tax-free. It's possible. It's possible.
Sure.
Never in this business.
Absolutely.
So I just wanted to throw that out.
No, that's an important point. Well, my friend, you did it again. You took some really complicated stuff and made it very accessible for all of us. No one is putting this type of information out there in the way that you do it. So thank you so much for what you do on behalf of all feds. Folks, that is a wrap. We are Serving Those Who Serve. Be sure to hit that subscribe button, whether you're on YouTube or Spotify. And please remember to share it with your friends and strangers. Don't forget our live webinars pretty much every single week. Go to swserve.com. You'll see the webinar button. Click it. The whole menu opens up. Sign up for one, sign up for all. Tell your friends. They will thank you. And be sure to read Ed every single week in the Fed Zone. That's fed-zone.com. So signing off for Ed, the crew at Serving Those Who Serve, and me, Dan Sight, I'm going to say, as I always say, good luck, Godspeed, and above all, remember, it's your Fed life, so please make it a great one because you deserve it. Stay well, everybody. We are out.